Most people believe investing begins with money, but in reality, it begins with psychology. Long before somebody buys their first stock, opens an investment account, or learns how markets work, they are already making financial decisions shaped by fear, uncertainty, and survival thinking. This is why so many people remain stuck in the saving stage for years. They are not necessarily lazy or irresponsible. Often, they simply do not feel psychologically safe enough to move beyond protecting money into growing it. Saving and investing may look similar on the surface because both involve setting money aside, but mentally, they are completely different behaviors. Saving is built around safety and predictability. Investing introduces uncertainty, delayed gratification, and emotional discomfort. The transition between the two is not really a financial shift. It is an identity shift. Imagine someone who spent years living paycheck to paycheck. Every dollar saved represented security. That savings account became emotional protection against emergencies, instability, and unexpected problems. In behavioral economics, this creates a strong loss aversion effect, where losing money feels psychologically more painful than gaining money feels rewarding. So when that person hears the word investing, the brain does not immediately think about opportunity. It thinks about risk. This explains why many people hold large amounts of cash for years, even while inflation slowly reduces its purchasing power. Intellectually, they may understand that investing historically grows wealth over long periods. But emotionally, the certainty of cash feels safer than the uncertainty of markets. The brain prioritizes avoiding pain before pursuing growth. The interesting part is that successful investors usually do not eliminate fear. They simply learn how to structure it. Instead of placing all their money into risky decisions, they create systems. They build emergency savings first, reduce high-interest debt, and invest gradually through consistent contributions. This changes investing from a dramatic gamble into a controlled long-term process. Mathematically, small, consistent investing matters more than most people realize. Someone investing $200 per month over many years may contribute far less than the final portfolio eventually becomes, because compound growth slowly begins generating its own momentum. At first, the progress feels invisible, which is psychologically difficult because humans are motivated by immediate feedback. But over time, the balance starts growing faster than the contributions alone. This creates another important psychological shift. The person no longer sees money only as something earned through labor. They begin understanding money as a system capable of producing future value on its own. That perspective changes spending behavior, long-term planning, and financial confidence. The real challenge of investing has never been intelligence. It has always been emotional consistency. Markets rise and fall, economies change, headlines create fear, and uncertainty never fully disappears. But people who successfully transition from saving into investing usually stop treating volatility as danger and start viewing it as part of a long-term system. And perhaps that is the most important mindset shift of all. Saving protects the present. Investing slowly builds the future. Both matter, but understanding when to transition between them is often what separates financial survival from long-term financial stability.